Welcome back to another always exciting and definitely not what you put your children to sleep to episode of Matt and Mike's Markets and Mortgages. I'm Matt Haberlie, Regional Manager for Success Mortgage.
And Mike Crumrine, Virginia Regional Manager with Coldwell Banker Premier. How you doing, Matt?
I'm doing pretty good. How you doing today, Mike?
Oh, I'm doing great, man. Thank you.
So what's going on today?
So, Matt, I had something that a few agents have asked me about, and it's something that I wanted to bring to you. It sounds like rates are starting to creep up a little bit. Some of the agents have been talking to their clients saying, hey, I feel like the rate that I originally got quoted when I started working with you, it's going up a little bit now. What's causing that sort of thing in the marketplace? That's not something I'm real familiar with.
Okay, not to, again, I mentioned people put their children to sleep by playing our shows, but yeah, we'll try to keep it light. Talking about the debt ceiling. And what's kind of been going on with that right now has directly impacted what's going on with mortgage rates.
Okay, gotcha. So you mean you're talking about the United States debt ceiling?
Yeah, the big one.
The big one.
Not unfortunately my own personal budget, but the big one.
Okay.
Yeah, because effectively, here's what's going on. Bills should have been passed, doesn't matter which direction, back in January. And through some creative measures, they've been able to buy more time. I would basically put this like if you rang up a credit card bill and then it was time to pay the whole thing off. And at that time you said, oh, okay, hey, give me an extension. I'll pay it in a couple more months.
Sure.
But with that being said, I mean, the number one thing, if anybody should know anything about markets, is they like stability. They like calm. That is the most important thing, is calm and stability. They like to know, just like your mortgage company likes to know that you're making your payment on time every single month without fail. That's what they like. So when all of a sudden you're extending out, you're not paying your bill on time, and then you're now coming up to the deadline of that, and you're sitting there going, I don't know, maybe I will, maybe I won't. Let me see if I can, talk to this other person involved and decide if we're going to pay the bill or not. That's scaring the ever-loving hell out of markets.
Okay, gotcha. That makes a lot of sense, because we're not talking about $50. We're talking about lots and lots
trillion.
of money. Trillions of dollars.
Right.
Okay, I'm with you. So because it's sounding like there is a chance that the United States may not pay what is owed when they owe it, that's causing instability in the market and making rates tick up. Is that correct?
Yeah, I mean, you can almost, there's a very interesting analogy that you can use with mortgages with this. So if somebody has great credit, you get a lower rate with your mortgage because you're showing you pay on time. On the reverse end, you have bad credit, you get a higher rate all of a sudden. Well, the treasury bills and bonds work in a opposite direction, because in that case, the government is borrowing money from whoever borrows those bills or bonds. So the United States has actually one of the lowest treasury rates, has to pay out interest of any country in the world. And that's just simply because they know, hey, we got all the money, we'll pay our bills on time, no problem. But when all of a sudden it's on whether or not we're going to pay the bill on time, just like if you stop paying your mortgage on time, your credit rating gets worse. Therefore, nobody wants to buy your debt unless you're willing to offer them a higher interest rate. You all of a sudden have to offer a higher interest rate on your return on your treasury. That then affects mortgage interest rates, and mortgage interest rates go up based on that.
Okay, I follow you. That makes a lot of sense. What do we in the agent seat need to be able to tell our clients about that to kind of help bridge the gap? Is that pretty much the analogy you would use, or would you say that differently?
Well, I'm sure you could come up with a more smooth, gracious analogy, but I mean, that would be the best way I'd put it. There's concern about defaulting, just like if you were a person who defaulted on your bills, your rates get worse. Our rates are getting worse. It's just that simple. It's, it really is. I mean, there's literally a credit agency called Moody's Standard & Poor that rates treasury bonds and who's got good credit paying back their bills and don't. And they didn't say they're going to, but again, just the mere suggestion of it can have a giant effect. They said they're thinking about downgrading the U.S. credit. So again, we have worse credit. We got higher rates for our treasuries as well as our mortgages.
I feel you. Okay,
Yeah.
so yeah, like you said, the market's like calm, and it's starting to not be very calm, which is making the rates get excited and things like that. So,
Exactly.
what's it look like for this to resolve and go back to a more calm place? I know normal's not the word, but a more calm place.
No, I mean, God, I haven't seen normal in years. I'd love to
I
see
remember normal when I was a
Right.
boy.
Exactly. I had less gray hair then. I think all the last couple of years have brought it all on. But the biggest thing is for them to pass a bill to raise the debt ceiling. That will settle down everybody. Most of the time, those bills are good for a year and a half, so we have nothing to sweat for another year and a half. We can be normal, at least on this one thing, for that long. That would be it. And you will see, because rates are approaching the low sevens. We were back in the sixes a couple of weeks ago. So I can see it going back to that once this bill gets passed. Everybody takes okay, we can relax now. No worries. The pillar of the world financial system will not crumble around us. Okay, we can relax.
Okay, I'm with you. Okay, that's really good information. I was just trying to process if there's anything else that maybe the agents should know from this. But that makes a lot of sense, and I think a lot of people don't consider that. So I appreciate you taking the time to explain that to me.
Mike, if I could throw in one real quick thing, just because I have to be safe here. We are making no promises nor guarantees of any rate going down after the debt ceiling bill has been passed. That is what logically should happen.
Should
not always logic happens, but that is kind of the theory of the case, that it should go down. So I just want to preface that in case you're going, no, I don't want to lock my rate. I'm going to wait, and then it goes up. Okay, I did warn you. It's still a risk to wait, no matter what you do when it comes to locking in rates. So you can either take the guaranteed thing you can have today, or gamble on tomorrow that it's going to be better. But don't cry if it's worse.
Well, and the fortunate thing is we're not talking about the difference between a 6 and a 10.
Oh,
we're talking high 6s to low 7s. So
yeah,
it's affecting people's affordability a little bit, but we're not talking drastic. We're not talking even near the kind of swings that we saw at the tail end of 2022 and things like that. So exactly. It's a little bit more manageable, but it's something we need to be aware of, and we need to be prepared to have the discussion. And I think that you gave us a real concise way to say that. People are recognizing around the world that there's a chance that the United States may not pay on their debt. And so that creates a little bit of, tumult in the market.
Exactly.
Cool. Awesome. Well, thanks for taking the time to explain that, Matt. I think that's going to be really helpful, and I'm excited to see how it's received in the marketplace.
Yeah. If anybody has any additional questions, your children can't sleep, they're making too much noise, you just want to bore them to death, you can always email me at Matt Haberlie, Haberlie, at successmortgage.com, and I'll put them to sleep for you.
There you go. And any questions about real estate, Mike Crumrine at premiermove.com, MikeCrumrine at premiermove.com. Thanks very much, Matt. Enjoy the rest of your day.